Today on Inside the Issues, I speak with Jason Thistlethwaite on financial risk and climate change. Hello and welcome to this week's edition of Inside the Issues, a CIGI online podcast. I'm David Welch, CIGI Chair of Global Security at the Balsley School of International Affairs and Professor of Political Science at the University of Waterloo. And it's my pleasure every week to welcome a guest into the studios here at the Center for International Governance Innovation in Waterloo to talk about some pressing issue of international public policy or global governance or international affairs. And today, I'm happy to welcome Jason Thistlethwaite, who's the director of the Climate Change Adaptation Project at the University of Waterloo. An ambitious-sounding institution, organization, and you're here to fill us in. Thank you for coming. I think most of us know what financial risk is. I think most of us now know what climate change is, but I don't know how many of us have actually connected the two up. So maybe we could start by you letting us know a little bit about the relationship between these two things that we don't normally think of as being related at all, I suppose.
Sure. David, thank you very much for the opportunity to be here today. I very much appreciate it, and I'm excited to talk a little bit more about this research and what it means for not only global governance, but also Canada. The discussion on financial risk around climate change primarily evolved through the realization that most financial decision-making, and in fact larger business decision-making, assumes that the climate will remain static. This is problematic because we're constantly making investments in assets that we think will yield a return over the short, medium, and long term based on this type of assumption that climate is in fact going to remain static. We now have a lot of evidence to suggest this is not the case. So what does this mean? There are a couple significant consequences as a result of this. The first one is that governments around the world have committed to, in Copenhagen in 2009, to keep their emissions below an increase in 2 degrees Celsius. So they've agreed to implement various types of policy measures, things like carbon taxes or cap and trade systems, to try and keep emissions below that point. That's a fairly ambitious policy statement that these governments have supported. The problem is that existing investments and future investment opportunities in various types of industries that produce the greenhouse gases that we're trying to reduce significantly are much more than the types of policy that we're trying to create. And what this means is there's a gap between policymaker ambitions and the existing capital opportunities throughout some of the greenhouse gas intensive sectors of the world. So if governments were to go ahead and actually implement policies that were to reduce greenhouse gas emissions below that 2 degrees mark, there's been a lot of analysis around this question and what the impacts are.
So indirectly and unknowingly, people have actually invested in climate change. I mean, they've invested in more than 2 degrees Celsius increase.
Yeah, effectively.
Right.
We have put our assets, everyone has a pension in Canada, everyone has a pension, anyone that has a pension. Most of our pensions are passively invested, so we put them into a fund that contains equities from various segments across the economy. A lot of economies generate a lot of value and a lot of return from areas around the fossil fuel sector and greenhouse gas intensive sectors. So the question that we have now is, if we're going to go ahead and implement these types of regulations, what happens to our assumed return on those assets? What happens to our calculations based on these policies, and how much those assets lose in value? So the discussion today is really focused on this concept of a carbon bubble. That in fact, if we were to go ahead and implement these types of regulations, markets could shift their preferences and pull out of a lot of these assets for fear that their extraction and refinement and production would increase emissions above that 2 degrees mark and be punished through some type of regulatory framework. So some of the details around this are starting to emerge, and there's been a lot of good financial analysis that's now been poured into this. But globally, HSBC, for instance, has calculated that if governments were to actually go ahead and implement this type of regulation, you could see a market value loss of between about 40 to 60% for some of the most significant oil and gas companies listed on global stock exchanges. In Canada, we're also very much exposed to this type of risk. Standards & Poor's, for instance, has been doing credit analysis on the regulatory risk for some of our most significant oil and gas sectors. Canada is very unique from this perspective in the sense that our extractive industries are highly capitalized. It takes a lot of money to get our oil out of the ground, particularly because it's embedded in sand. So this is a very difficult and technical process. Because they're highly capitalized, a reduction in, or a shift in perception of the way markets perceive the value they could be getting out of those extractive assets could lead them exposed to significant debt. So the most recent calculation has been the debt could increase to 2.5 times EBITDA if we try to actually keep things below that 2 degrees Celsius benchmark. So that's assuming that governments go ahead and actually do implement some type of regulation to do this. And there's no evidence that that in fact has happened as of yet. And when you go around and you speak to people within the financial industry, this issue of regulatory risk and the fact that governments are going to do it, I mean, it ebbs and flows. Mm-hmm. In Canada, it ebbs and flows with what Obama says. If Obama says that this is going to be an issue, Canadian financial industry starts to go, okay, well, what could be the price of this? What could be the potential implications for our sector? But for the most part, you know, the financial industry is skeptical that this type of regulation could come into place. The argument that is being made by a lot of groups out there that are researching this is that, well, you may be skeptical about whether or not these regulations are going to come into place and impose costs on the extraction of these goods, but they believe these regulations are almost inevitable, given the type of catastrophic implications that groups like the World Meteorological Association, the United Nations Environment Program, and the International Panel on Climate Change, or Intergovernmental Panel on Climate Change, have predicted would happen if we go ahead and release these types of greenhouse gases. So in the event that they say they don't act and the governments say, okay, well, we're not going to go ahead and regulate these types of emissions, we may be able to avoid some of these significant liabilities. But where we're exposed to an even more liability that is even more difficult to calculate is physical risk. Mm-hmm. So what happens to various industries as the climate actually starts to change? And very much the canary in the coal mine when it comes to physical risk is the insurance industry, the global insurance industry. Property damage losses and claims have been increasing steadily for about the past 50 years. In Canada, we had our first $4 billion year in claims in 2009.
From extreme weather events?
Extreme weather events. These are correlated to exactly extreme weather events. So in 2009, we had our first $1 billion year. Every year after has been $1 billion year. So very much we're looking at a new normal here. Mm-hmm. This is not good news for underwriting in the Canadian property and insurance industry.
So there's risk on both sides of the equation here. There's risk if you do wrestle greenhouse gas emissions to the ground, and there's risk if you don't.
Yes, and the talk now among a lot of major insurance companies revolves around a discussion about the availability and affordability of insurance. As risk increases in certain areas, insurers have two options. They can raise the rates, or they can stop offering insurance in that area. Raising rates is a novel strategy. Property insurance contracts are renewed on an annual basis. So you can have an opportunity to say, okay, the state of Florida has seen an increase in the frequency of hurricanes. We need to raise rates on various properties that are exposed to these types of things. The issue with that is that you can only raise rates to a certain extent. At that point, it becomes too expensive, not only for the property owner who has to pay the rates, but also the insurer themselves to actually transfer that risk and manage that risk and cover that type of risk. And you've seen this happen, specifically along the Gulf Coast in Florida. It is very much a case study on what some of the coastal areas and some of the more exposed parts of the world could face when it comes to something like climate change. So you've seen insurers pull out, raise rates. People get angry. They're going to go to their congressman. They're going to go to their elected official. They're going to say, how dare these insurance companies raise rates to this level? And so that invites another type of regulatory risk where regulators may come in and say, you have to keep your rates down. And that's bad news. You know, ideally, we want the market aggregating all of the information and best information and having the experts go ahead and actually manage this type of risk.
Fascinating. It's squeeze a bubble in one place and it balloons in the other.
That's right.
We'll be back in a moment again with Jason Thistlethwaite. You're watching or listening to Inside the Issues, a CIGI online podcast. Look for us at cgionline.org, on Facebook, on Twitter, and on YouTube. Welcome back. So I guess one of the things that governments could do in the face of public pressures of the kind you were just talking about was socialize the risk. But then that creates a kind of a moral hazard, doesn't it? It disincentivizes people from reducing their emissions, and it disincentivizes, I suppose, insurance companies from properly aggregating risk.
The problem with socializing the risk, something like that, is that, of course, we don't want taxpayers suffering the burden of these extra added costs. But when you do that, you lose some of the most important aspects to having a private insurance market. And that is that the insurance industry is better than the government at responding to natural disasters and extreme weather events. They're experts in this space. They'll have people on the ground very quickly. They know how to assess damage rates, and they know how to get behind it very quickly. So there's increasing evidence, and for the first time this year, the Bank for International Settlements actually took a look at the role of the private insurance market in response to something like climate change and natural disasters. And what they discovered is that after significant events, areas of the world that actually have robust private insurance markets can see an uptick of about 1% of their GDP. Insurance payouts will come out, they'll fuel investment in things like construction, new building practices, and resiliency measures to these types of risks. And so this is an efficient functioning market. You may lose those incentives if the government has to go ahead and take over and become the insurer of last resort. Not only that, but of course, if a government takes over some type of insurance, it's exposed to a lot more political pressure. Needless to say, we don't want people paying extremely high insurance rates. They're sure to go to their governments and say, hey, can we get subsidies and reductions in these types of rates? And that's in fact exactly what's happened in the state of Florida, which has now a public insurer. It's very well known within the insurance industry that public insurer does not have enough capital through its premiums and the rates that it actually imposes on people to cover a significant type of loss. So there's a great deal of risk there. Insurance is important because it has a big implication for our mortgage markets. Without insurance, you can't get a mortgage. There really has not been much analysis on this vital connection. Some areas in Canada, some areas in North America, some areas in Europe will inevitably face issues related to high insurance costs and the availability of insurance. What does that mean for the mortgage markets in these places? What does that mean for banks who are relying on returns from those type of investments? So insurance and the physical risks play a significant role.
So a couple of questions there. So one is a lot of insurance policies on property don't cover acts of God. And so extreme weather events in many cases would just be, I would imagine, not covered, period, on the basis of your policy. And people be on the hook anyway. Secondly, from what we saw recently with so-called Superstorm Sandy, if there's enough property damage, the government will sweep in and clean it up and help pay for it, whether or not you're insured. So there's almost an automatic default assumption that the government will come bail the people out, property owners out. And third, this may be wrong, but I would imagine that if it gets difficult to insure property, it will depress property values, which would then make it more affordable for the insurance companies to cover property and sort of equilibrate. So many different moving parts here. I'm trying to sort out in my mind whether this nets out. That
sure.
In the aggregate, it'll net out, and so we don't have to worry about it as long as the market's efficient. Or are there sort of nonlinear cascading risks in some direction where it'll basically kill insurance for property, and we simply won't be able to rebuild in the face of extreme weather events?
Well, there's a couple knock-on implications there, right? First of all, it's a bit of a misnomer to say that insurance industry doesn't cover acts of God. A lot of the insurance coverage that we see now in property does in fact cover acts of God. So,
depends on the policy typically.
It does depend on the policy, but for the most part, people are insured for hurricanes. Whether or not that is considered an act of God, people are in fact insured for it.
You can buy separate hurricane insurance policies, I understand, in some places.
Yeah, so in some places, insurers have said it's such a risk that we have to actually separate it out of the main property policy and impose our own rates on that particular area, and it's just prudent financial decision making. So they do cover these types of events. There are implications from the moral hazard. The insurance industry doesn't like it when the government has to step in and sort of take over and the management of these types of risks. It doesn't respond as efficiently as insurers tend to do, who have on-the-ground expertise on where the risks are and a lot of data on how these risks pan out. But there's an important knock-on effect here. Insurers are major investors. They take premiums and they invest them in very safe investments, and they're regulated to put them in safe investments. They can't be making risky decisions with their investments. So it's a big net contributor to pensions and mutual funds around the world. And they tend to be relatively safe investments for a lot of people.
And they're probably investing in greenhouse gas emitting industries.
It's one of the areas that the insurance industry has to take a very good look at.
Right.
And there are initiatives out there that are now taking a look at the exposure of this. And it is a very sensitive area for a lot of insurers. For the most part, they outsource how they do their investments. They'll give it to a fund manager. And that separation there between the underwriting side and the investment side is highly problematic from the perspective of climate change. Those two silos there oftentimes don't effectively communicate. So you'll have one
working at cross purposes with the other.
Working against the other. And there are much more significant efforts to try and resolve that type of silo.
It's quite complicated. We'll be back again in a moment with Jason Thistlethwaite. You're watching or listening to Inside the Issues, a CIGI online podcast. Look for us at cgionline.org, on Facebook, on Twitter, and on YouTube. Welcome back. So my friends in the financial sector keep telling me that there's no such thing as a unbridled downside risk. There's always an upside opportunity anytime you see one. Have you looked at this at all? Are people beginning to sort of look at this strange situation where we're assuming incorrectly that the climate is static and recognizing opportunity there? And are we starting to see any shift of capital towards things that would leverage these opportunities and generate significant financial returns?
This is really interesting. It's a great question. In about the last 10 years, we've seen the emergence of a real movement within the financial industry. And for the most part, this movement's defined by very interesting and innovative collaborative partnerships between financial firms, environmental NGOs, investors, and the accounting industry. And their efforts are primarily revolved around developing the type of information and methodologies to understand and measure our exposure to something like climate change risk, and then turn that into products that take advantage of certain opportunities. So I'll give you an example. The insurance industry, just like the financial industry more broadly, looks at the last 100 years to understand what to invest in for the future. So they'll look at those stats and say, okay, well, here are our risks down the road. Climate change is problematic. It's a future type of event. So you have to introduce a whole new way of thinking for risk modelers and asset managers. And this new way of thinking is to start taking a look at what some of these future risks are. By doing that and integrating those into your investment strategies, you go through a process of climate proofing, where you'll begin to identify assets that potentially could be left stranded by investors, as opposed to assets that could see an increase in their potential market return. So some of these initiatives, and I'll give you a couple examples, they're very much focused on developing ideas for risk disclosure. So how do we measure the financial risks of climate change throughout the sector? Groups like the Carbon Disclosure Project in the UK very much pioneered this process through using a voluntary standard that would ask companies throughout the world to disclose their exposure to these risks against a common benchmark. Investors then take a look at this information and theoretically will then pressure firms to reduce their exposure to these types of risks. But that movement is very much grown in sophistication. And now we see a much more significant partnership occurring between these people who want to know about exposure to climate change risk and the accounting industry.
If you had a carbon tax in a jurisdiction, though, you'd have those data anyway, automatically, wouldn't you? Because people would have to be accounting themselves for their carbon.
So yes, and right now financial institutions do something called shadow pricing, where they take a look at what the impacts of something like a carbon tax would be on some of the biggest investments they have. The problem with that is we don't understand more broadly how consumers are going to respond to a carbon tax. How will market demand change for various industry and products that come from some of the sectors that could be exposed to higher costs? And that's a bit of a black box. And so allying with groups like the accounting industry, what they're doing is they're placing a significant emphasis on developing standards that will eventually be incorporated into international financial regulations. At least that's the trend we're going right now, that focuses on decision useful information. Mm-hmm. So what is decision useful for an investor? There's a lot of erroneous information on what is a climate change risk and what isn't a climate change risk. This partnership with the accounting industry has really emphasized that we need to be focusing on what investors find decision useful. And they're experimenting, and they're going through a process of refinement whereby they improve these standards to the point that investors will go, okay, I now can compare across the entire industry where these risks are and where they aren't. there's been an important development in the last few years where domestic securities regulators have picked up on this. And for the first time ever in 2012, the UK government announced that it would require any firm listed on the London Stock Exchange to disclose their greenhouse gas emissions, and potentially even disclose their exposure to these types of wider risks. So not only are you seeing this movement, to develop all these types of voluntary standards, but you're beginning to see the emergence of a consolidation in international and domestic financial regulations, where we really try and emphasize how we understand these risks. With that type of information, with that benchmarking, where risk isn't, where risk is not, we can then start to develop products that will exploit that sort of opportunity side. So things like the development of a national carbon budget. How much carbon does exist, potential carbon does exist in our securities markets, and how will that then be regulated? What are the costs of regulating that carbon? You then can develop different financial instruments that people can invest in that are climate-proofed. Things like green bonds, bonds that people invest in that will produce a return, bonds in green energy, for instance, that would be an example, or renewable energy. Certainly these renewable energy markets are going to grow in their size based on the assumptions of this changing climate and the assumption that governments will at some point get their act together on this file. And so you'll see more of a return coming from them. Another idea would be the use of carbon stress testing. The financial industry after the 2007-2008 crisis engaged in a serious degree of stress testing to understand how their capital was exposed to things like the subprime mortgage crisis. Similar types of stress testing can occur on the carbon side. So that type of information can then be used to say, okay, well, what industries, what sectors could benefit? And there are some very easy examples. In northern climates, agriculture potentially could see a growth in its market expansion. There could be a lot of value in Canada, Russia, for example, you could see a longer growing season. And that is certainly an opportunity that could be exploited as opposed to other areas. Mm-hmm. Resilient properties. So if we, places like New York, for instance, and a lot of the major commercial property hubs throughout the world are located close to coastlines. Mm-hmm. They're exposed to sea level rise. Where can we put these properties, or how can we develop properties that are resilient to these types of risks? Tenants will, and the market will begin to favor these types of properties. They'll have lower insurance premiums, which means lower rent rates, and fundamentally a more habitable experience for people there. So there are a couple examples. Certainly anyone that is promoting renewable energy more broadly, markets should begin to start recognizing that the premiums on investment there, or the risk management cost of investment there, will go down. So I think those are some of the big opportunities that we're looking towards.
Very good. We'll be back one last time with Jason Thistlethwaite. You're watching or listening to Inside the Issues, a CIGI Online podcast. Look for us at cgionline.org, on Facebook, on Twitter, and on YouTube. Welcome back. So the adjustments that you've just been describing have been taking place within the context of the dominant paradigm of economic behavior, which assumes the possibility of open-ended growth, which in principle might imply the open-ended possibility of resource consumption. We're on a finite planet. Mm-hmm. So some people have said we have to change this way of thinking. We have to do at least two things. One is embrace natural capital accounting, start factoring in the costs of actually extracting non-renewables. And secondly, find a way to adjust our economic thinking so that we stop worshiping growth as an economic goal, and figure out a way to live within a sustainable, open-endedly sustainable economic environment where we count things in ways that don't result in killing us in the long run.
You're right.
By plundering the planet. So these adjustments you've described sort of go halfway, I suppose, down that road. Do we have to go the whole way down that road, in your view? And if so, when should we start strongly encouraging people not only to think about assets that might be climate change friendly, but ways of thinking about the economy that in the long run are planet friendly?
For a long time, well, actually more recently, the climate change movement has been sort of more of a source of criticism, specifically after the US didn't move on its climate change regulations during the Obama administration's first Congress. And the argument by the environmental community was that, we need to be paying attention to more other areas of the environment that potentially have more of a link to the way we live. Water scarcity, toxic waste, these types of things, which are on-the-ground type of measures. This effort by the financial industry and the groups involved in the financial sector, NGOs and so on, to go ahead and take a look at how we're going to start pricing climate change risk, I see that as the beginning of a broader effort to understand how we're going to go ahead and start measuring the price of things like natural capital. It's very difficult to move someone within the private sector without a good cost-benefit analysis. And if we don't know what the costs are to begin with, it's very difficult to move into what the potential benefits are of shifting an economy towards the valuation of things like natural capital or ecosystem services. So the methodologies that are being developed, for instance, to go ahead and, 'cause I should backtrack for a second here. It's all about what the costs are going to be in the future. And it's very difficult to do that, specifically when the sector relies so heavily on statistics that are historically focused. So for the most part, the industry is, to date, driving a car by looking at the rearview mirror, which, as we know, would be very dangerous.
But at the moment, we don't force people to cost in natural capital drawdown at all.
Right, so if you're going to convince financial regulators and policymakers more broadly to do this, we actually have to have a technical consensus on how you actually go about measuring and valuing these goods. And that technical consensus is very difficult to come by. It's exposed to a great deal of uncertainty. So some of the governance initiatives that you are seeing emerge here are bringing together these quants within the financial industry to develop better statistical models and measurement approaches to understand how you go about doing this. Then you can make a case for regulation or political consensus building. And many of the groups that so groups like the Climate Disclosure Standards Board, the International Integrated Reporting Committee, these are alliances between NGOs, investors, and the accounting sector. And their entire goal is to bring all of this investment, all these ideas into a financial statement. That financial statement will trigger the financial industry to, will send a signal throughout the financial industry that you're not paying attention to certain liabilities. And then hopefully the financial industry will then respond by shifting the way it invests capital. That should hopefully be an incentive that you convince consumers and so on to begin paying attention to these types of natural capital costs and benefits. So we've known for a long time that when it comes to political decision making, the financial industry is a very big player. And it can do this by directly through its lobbying influence, but also indirectly through the way it prices things throughout the economy. And so I think those are two big, powerful tools that many of the initiatives that are focusing on issues like climate change risk and governing climate change risk, I certainly do believe these are doorways that we're going through right now. And there's a lot of heavy lifting that needs to be done in the short term. But soon enough, you'll see consensus emerge, and specifically because financial regulators are now asking for this information. They believe it's material now. So a great example is in February of this year, the SEC released a letter in response to a shareholder resolution to a West Virginia bank. Shareholders, a fund that invested in that bank, wanted to know how they were exposed to climate change risk. Not only through just shadow pricing, through putting a price on a ton of carbon, but across their entire investment portfolio. The company used existing SEC rules to say, well, we can ignore this resolution because it's not ordinary business. The SEC, according to some leading US financial experts and environmental experts, set a precedent by issuing a letter saying, absolutely not, climate change is fundamentally material to the performance of this bank, and you're now going to have to explain how you're managing these types of risks. That goes straight up to the CFO and straight up to the CEO. So you're seeing a shift.
That's interesting.
Yeah.
That's a national body, SEC, US body. How much of this innovation are we seeing at the national level? And how much are we seeing at sort of transnational?
Most of the groups I talked about are transnational. That's what makes them very interesting. They look at the financial sector as a global institution, and when they see risks emerge, they see it as material to the entire institution. Right. This is very much built around the concepts that we learned out of things like a financial crisis. Right. That when we overvalue assets in one part of the world, it doesn't matter. It can create a systemic risk for the entire financial system. When groups like the SEC and UK securities regulators adopt these types of standards, they are the dominant financial powers when it comes to the size of their markets. Mm-hmm. If they impose standards on their markets that most companies like to have access to, like to list shares in, that's market power.
Effect.
Yeah, other countries will be pressured into doing the same thing. to ensure that their companies don't suffer some type of competitive disadvantage. Not only that, but at the international level, groups like the Financial Stability Board, they're right now placing a much more significant emphasis on enhanced risk disclosure. We missed things during the 2007-2008 financial crisis. So they've created a task force to take a look at how can we improve risk disclosure. A lot of the ideas they're talking about would include climate change risks. So from my perspective, we really are entering a new era of risk disclosure and risk governance with an enhanced focus on things like environmental and climate change risk.
That's absolutely fascinating. I've learned a great deal. One last question for you,
Sure.
if I may, before we go. Do the emerging economies that have been resisting restrictions on their greenhouse gas emissions have any clue that this train is coming down the track and that they're going to be hit in the back by financial regulations in the major markets that are going to force them to change their behavior or else suffer enormous competitive disadvantages?
I'll say this about the emerging economies. The case around climate change is easier, and these types of environmental risk, I think, is easier to make in those economies. They are disproportionately and asymmetrically exposed to things like climate change compared to developed countries that have a robust infrastructure, have robust private insurance markets. So to a certain extent, they
have an incentive to get on board.
They have an incentive to get on board.
Are they aware?
Be early adopters. I definitely think so. Look at China right now. China is revisiting its decision-making processes about investing in the Canadian oil sands.
Right.
Why is it doing this? Well, they've seen the political uproar in the United States, and they've seen these non-economic costs, things like the impacts to the environment, things like the political consequences of further investment there. And that's troubling. The oil sands are an important part of the Canadian economy, and a large part of the oil sands are foreign investment. And for getting these signals from other countries, I think that's a troubling sign. So for the most part, because climate change is much more of a significant and in-your-face issue for the emerging economies, it'd be worth a wager to say that they could become leaders in this space.
Very interesting. Well, thanks again. I really appreciate your coming in and shedding light on this for us. Very complicated topic, and I hope our audience agrees that it's been eye-opening and informative, and thank you very much for joining us. Join us again next week for another episode of Inside the Issues, a CIGI Online podcast. Look for us at cgionline.org, on Facebook, on Twitter, and on YouTube.